Welcome back to the second video of our Introduction to Financial Accounting series. So you can see here the definition from our past video, which is accounting is a process of identifying and recording economic transactions. Yes, this is only the first half of our definition. Once again, let's review what an economic transaction is. An economic transaction, also known as an economic event, is simply a happening of economic consequence. The example we had for an economic transaction was buying a piece of land in exchange for cash of $100,000. This is definitely an economic transaction. So, of the two parts of identifying and recording, we can definitely identify this as an economic transaction because it has an economic consequence. You're currently $100,000 short of cash. At the same time, you have property, land, which is worth $100,000 in exchange. So more importantly, over the next few lectures, recording economic transactions is going to be the main crux of these next few lectures. So the accounting profession has developed standards which are meant to be universal and easy to use. These standards are used to record economic transactions. Some of the well-known standards in use are the U.S. GAAP and the IFRS. In our series of lectures, we'll be mostly dealing with U.S. GAAP, but it's important to differentiate between U.S. GAAP and IFRS. GAAP stands for Generally Accepted Accounting Principles. In the early 1930s, the United States Congress gave the SEC, Securities Exchange Commission, the right to set the standards. However, the SEC relies on FASB to set the standards. FASB stands for Financial Accounting Standards Board. Outside of the United States, most commonly used formal standards are the IFRS. It stands for International Financial Reporting Standards. The IFRS, or the International Financial Reporting Standards, are set by the IASB, which stands for International Accounting Standards Board. Now, part of the U.S. GAAP and the IFRS are standards which are different in some instances, in some instances they're exactly the same. There has been a recent moment to converge these standards to make it both simpler and also in order to make financial statements across nations of different global companies more comparable. This has been called convergence. While this has been widely successful in some areas, a lot of progress still needs to be made in other areas. So now that we know about the two types of standards, or the two most common types of standards, we're going to move on to the measurement principles, which are key in order to record economic transactions. Two important measurement principles are historical cost and fair value. They're both almost self-explanatory. The historical cost relates to the original cost, while the fair value is the current fair value of a product. What is the fair value? The amount of money, the amount of value it is given by a reasonable buyer. The difference between an original cost and the fair value is, look at it this way. In the case above, we purchased land for $100,000. Its historical cost is $100,000 when you purchased it. This could be in 2009 or even 1909. Doesn't matter. The year doesn't matter. The original historical cost remains the $100,000. But the same value of land at fair value could be, in 2016, it could be $1 million. That's the fair value of the land. So, how do you report land? Is it going to be at original cost, or the historical cost, or is it going to be at fair value? We're going to be talking more about assets such as land in the future videos. But relevance and faithful representation are key in order to determine how we're going to be determining its measurement. That could be either at historical cost or fair value. Another key set of assumptions important in recording economic transactions are the monetary unit assumption and entity assumption. So, monetary unit consumption basically means that all the transactions can be expressed in terms of money. While the entity assumption basically says that each entity is separate and independent. From its owner. So a good example of this will be, say I own a share of Apple, which I bought for $100. My share of Apple makes me an owner of Apple. However, how Apple operates, how it has different economic transactions on a daily basis has nothing to do with my personal life. So my personal job, and the money I make or the expenses I have it has nothing to do with Apple's revenues or expenses. So it's important to understand that the entity is separate and independent from the owner.